Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings Monthly Conference Call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star 0. I will now turn the call meeting over to Sarah Potowski. Go ahead, Ms. Potowski, your line is open.
Thank you. Good afternoon, everyone. Thank you for dialing in to the call today. Our speaker on the call is David Burrows, President and Chief Investment Strategist. Today, David will discuss our current investment themes, actions we took through the correction, and our outlook and positioning going forward. With that, I'll pass it over to David.
Hey, folks. Thanks for taking the time today. I thought maybe we could just quickly revisit strategy for a moment, look at a little bit of history, and then look at what we've been doing recently in the portfolios and what our work is showing us here as we go forward. I think everybody knows that we spend a lot of time using the process that we have, disciplined leadership approach, to make our decisions, and we spend a lot of time trying to find securities where we can see based in numbers something changing for the better, and that are acting the way that they should be given what we think we know, and that's, security selection is about finding situations that can be revalued versus their peers. But we have spent a lot of time talking about the fact that a big part of return is driven by the macro environment that we're in and trying to get to themes and sectors that have some kind of a tailwind that can lead to a revaluation. And I just want to revisit how the breadth models work that we use to help us target where money's getting put to work and how maybe when the tide is going out where risk is elevated. If you take a universe of securities within a specific sector, then you head into a decline. The weak securities sell off at the beginning, and as time goes by, the stronger and stronger securities are impacted until late in the decline. Even the leading securities often are taking a hit. And when breadth is deteriorating like that, it means you've got fewer buyers than sellers, and you've got the wind in your face. Now, at some point when people get more comfortable, go out on a limb and start putting money to work at those rotten times, they don't buy the weakest securities, they buy the strongest ones first. So the ones that held up well through the decline tend to rally at the beginning, and then buying will spread to more and more securities. So I think, as you know, when we start to see deterioration in breadth, very often it doesn't show up in the index for some period of time. And it may be that the leading securities behave very constructively for a long time while the weaklings start peeling away. And it's not till the very end of a correction, it tends to be, that the leading securities are being hurt. Now, when you get late in a decline, you'll get down to 30% or fewer of the securities within a universe holding up in price. Everything else is selling off. And I think most of you have been through our presentation, and we've often put up the chart, for instance, of the 1980s and 90s, where we look at the NYSE through this lens. And for instance, in the 80s, we show that over that decade, despite the fact you were in a long rising market where the market averaged about an 18% return per year, there were 6 significant corrections that took place when you look at the market through our model. In each case where the market got to a point where fewer than 30% of stocks were still holding up in price. And any time you got below that 30% level, and then the percentage of securities performing well started to improve, it was time to put money to work. And in every case, there was tons of bad news, and in every case, there was very little confidence. But in every case, when that breadth model showed improvement, it was time to get to work. Similarly, late in tactical rallies, you might get to a point where 70 or 80% of securities are performing well, almost everything. And those are the times when fundamentally you can find all the reasons why it should be doing well. It generally means people are pretty fully invested. So we've used this breadth model for a long time, and as you know, when we start to see deterioration, it doesn't mean we go sell everything, but it does mean we take some actions and we raise a little bit of cash, and then as positions that we own are impacted, we will stop ourselves out of positions one by one. And rarely is it that markets get creamed right at the beginning of a correction, right? It takes time for selling pressure to eventually erode its way through the bid side until ultimately the bids step away. So, for instance, I think you all know in 2008, June, breadth in the NYSE started to deteriorate. We raised a bit of cash and progressively through the summer went from sort of 25% cash to 75% cash. And then in September, finally, the string broke and the market fell 38% over a course of a 2-month period, September 25th through November 20th. and through using our process, got to a point where we were well defended, and the market went down 38% over that following 2 months, and been anywhere from 2% to about 8% during that same period. And it's not about being protected at the first moment, it's being protected when finally the string breaks. So if you look at what's happened in the market over the last while, if you look at what rallied coming out of the decline in energy last year, 4 sectors really emerged as being the strength, and they were all sectors that benefited from a low energy price deck, and that was, the consumer discretionary stocks, retail, internet retail, travel and leisure, home builders, all had pretty persistent good conditions and strong price performance coming off those lows last August, a year ago. And interestingly, that sector does do well given low energy prices. And some of the stocks consolidated from April until August, but really no technical damage until 2 weeks ago. And 2 weeks ago, we had those bad days, Thursday, Friday, and then the Monday morning when the market opened down 1,000 points. And if you were to take the leading stocks in those group, really, it was almost as though nothing had been happening up to that Thursday, and of course the Thursday, Friday they got hurt. Healthcare was another key theme that we've been focused on since last August. Same thing. You look at the pharma stocks, the devices companies, the healthcare providers, virtually impervious to the decline until last few days when things got really tough in around August 22nd, 23rd, 24th kind of thing. Technology, similar, and financials, similar. Now, on the week, I guess in the third week of August, some of the leading stocks started to get hit. And while very few of our stocks had hit stop losses because those themes held up so well, we started to see some leading stocks get hit. And that caused us to put some hedges on in the portfolio. And so, on the Thursday, Friday, Monday, while the index really got hurt, portfolios held up, pretty well. I think from August the 18th to August the 25th, the S&P went down 11%, the MSCI World Index went down 9%, TSX went down 7.5%. I think in the main pools that we run, the income fund went down 3% in that period. Balance pool went down 3.25. I think equity went down 4, and the global macro went down 2. So, sort of once again, by the time we got to the real watershed event, portfolio is pretty well defended. So, what I want to do is look at where things are today, because it's important. We hear all kinds of folks talk about how, well, the leading stocks are getting hurt. Maybe this means we're headed into a more extended decline. And we have been making the case for the last 2 to 3 weeks that it does not look to us like that's the situation. And I think our look at the breadth model that we use for global equities, breadth started to decline in world equity markets, largely led by overseas markets, in April. And as we sit here, early this week hit a low of 16%. So remember I made reference to the 80s a few moments ago, in the 90s. When you got to below 30% is when things were getting sold out. And when breadth turned higher from those low levels, in virtually every case it was time to put money to work. So the world bullish percent reading got to 16% about a week ago, and since has turned higher. The Canadian stock market turned down early this spring from a breadth perspective and weakened through the course of the summer, currently sits at 26%. To put that in context, the breadth in the Canadian market is as weak as it was at the worst point of 2011 and at the same level in 2008-9. Now that has not turned up, but is on the verge of turning up. The U.S. equity risk model got to a low of 22%. Again, the same level it got to in 2011, and only a few percentage points above the lows of 2008. That has turned higher. So there's all kinds of things to worry about, always. And certainly when markets have been difficult, people are quick to point at the fact that there's fundamental weaknesses in different parts of the world, and maybe we should be really cautious. These breadth models historically have been great at giving us sort of counter-trend moves, helping us to recognize when the tide is out but starting to come back in. When we look at the sectors that we've been investing in, those four key sectors have been consumer, healthcare, technology, and financials. All four of those sectors were the last sectors to break down, and on any strength we've seen over the last couple of weeks, respond to the upside. When we look at the stocks that we own, or the ETFs that we own in the global macro portfolio, they held up literally to the Friday before the Monday morning. Now we got to ask questions as to whether it was that on Monday we got stopped out of a lot of stocks. I want to just make it really clear about stop losses. The only time we will not execute on a stop loss is in the event of a break in liquidity. Like, for instance, if the market were to open down 1,000 points. The idea of pushing securities out over a ledge when there's no bid in the market really makes no sense, especially given the fact that the breadth models were at extreme low levels. So in other words, these were the last stocks breaking down. Now, all of the stocks that we own and all of the key sectors that we're in are now trading substantially above where we got to on that Monday morning. We are seeing breadth improve. The index charts themselves, when looked at through the point and figure lens that we use, are showing marked improvements. So we would say that it's highly likely that the worst of this correction is over with. It's not to say that you can't get retests. It's not to say that you can't get wobbles. But when we go back and look at other secular bull markets, there's a couple of key points I want to keep in mind. First thing is, when corrections come, they tend to be short and sharp. They're over with quickly, and within a couple of months seem like the thing of the past. In previous secular bull markets, when corrections come, the leadership is the last to break down, and leadership persists. The sectors that are benefiting from whatever the secular change is continue to benefit. And very often the same leadership coming out of a correction as the leadership going in. Our work points to this. And third, it tends to be that in a secular bull market, correlations, or the degree to which stocks and sectors behave the same as one another, fall all the way through a secular bull market, meaning there's certain sectors that are clear winners and certain sectors that are clear losers. So when we look at our sector work and the various groups that we can focus in, here are the sectors that have turned higher since we started seeing improvement in the breadth readings. Home builders, insurance companies, textiles and apparel, meaning branded apparel, drugs, software, internet, healthcare as a whole, Wall Street, which is brokers and asset managers, auto and biotech, and finally restaurants. So if you were to put those into buckets, you get consumer, healthcare, technology, and financials. So the groups that led going in have been the groups that have turned higher in our breadth models coming out. So as you know, in the various mandates that we have, they're very flexible. And our job is to try to get to the parts of the market that are working and stay there as long as they work. Our job is to play some defense when the tide goes out in the market or in a sector. I feel confident that we did a pretty good job playing defense going through this decline. But I also, at this point, feel that now the balance of evidence is that markets go higher from here. We've said through this correction we think this is a short, sharp correction that will resolve fairly quickly. And it looks to us as that is likely the case. We could have a few more weeks of sloppiness, but I think that based on what we're seeing, actually the likelihood is that we can keep working our way higher here. In the portfolios as it stands today, if we were to look through the main mandates, the income portfolio, which can be anywhere from government debt, corporate bonds, preferred shares, real estate investment trusts, and all the way to dividend-paying common shares, the lion's share of the holdings are in dividend-paying common shares, largely dividend growth focused. We continue to have a very large U.S. weighting, frankly, because it was the last market to break down and the first market to break out. 70% of the holdings are U.S. equities. 28% would be Canadian equities. From a sector perspective, the biggest weight is financials. Should rates start to rise, that is the group most likely to benefit, 24% of the portfolio. We expect that we will get very strong dividend growth because these are U.S.-based financials, where the dividend growth should well exceed what's happening in the Canadian market. We do have some cash in the portfolio. As it stands, about 18%, and we are picking our spots and deploying that. Consumer discretionary and technology are 14 and 11%, 8% of the portfolio. So largely invested in equities, largely invested in dividend growth. And as I think most of you know, over the last week, we took hedges off in that portfolio, and it's floating higher. We're getting great dividend growth out of the portfolio. Dividend payouts in the S&P are still only 37%, well below the long-term average of 50%. They are trending higher. Cash weight is still way above long-term average as a percentage of assets on the average corporation's balance sheet, just about 5% of assets. We're seeing lots of buybacks. Since April, when we probably were at our worst point relative to our benchmark and peer group, we picked up roughly 9% versus the benchmark, and that's by not giving back through the decline. Certainly, since April, there's been significant weakness in energy and interest rate proxies, which we are not focused on. When we look at the chart for the bond market, long-term bonds and mid-term bonds, yields are moving higher. We don't think that bonds are an option at this point, especially sovereign debt or high-quality corporates. When you look at the equity portfolio is 75% focused in the U.S. It is back at 100% invested. Big weightings are consumer discretionary at 24%, technology at 21%, healthcare at 21%, and financials at 15%. This portfolio is back virtually fully invested. Global macro portfolio is 95% invested as of today. That portfolio is hanging in particularly well. If you go through returns just for the year, again, it's maybe a little disjointed, where the S&P is down, I think, 3% on the year and TSX down 5%. As of last night, the equity fund is up pretty much bang on 8%, 7.96%. Balanced fund up 3%. The equity pool is up 6%. Global macro just shy of 10%. Long shorts up 2%. Balanced pool is up 4%. The income pool is down 4% on the year and has made great gains against its benchmark over the last couple of months. So virtually all of the pools are well above water, certainly well ahead of benchmarks. I think we've had significantly less volatility than the market. And given the fact that there's still low correlation in the market and we're fairly targeted in the groups that have turned higher on our breadth model, we're feeling pretty confident that we're positioned for market rallying coming out. If we do get a Fed raise tomorrow, it'll be the most telegraphed move in interest rates that I can point to. So I'm not saying not to worry about rising interest rates. I would if I was a bond investor. But we're structured in our portfolios for rising rates with dividend growth-oriented securities and sectors that will benefit with a slowly improving U.S. domestic economy. So, look, we continue to believe that we are in a secular bull market driven by booming oil production, which means that the price deck for energy is likely to stay low for a long period of time. Fundamentally, it makes sense that the U.S. market was the last one to roll over and the first one to turn higher during this correction. The magnitude of the correction is in line with what you tend to get in a secular bull market, both in time and in price. Could we have a few more weeks of sloppiness? I suppose so. But the breadth models are showing improvement, which means the balance of evidence is that the market over the next couple of months works higher, not lower. When we look at valuation, the PE of the top 50 stocks in the S&P today is about 15 times next year's earnings versus where we were in 2000 at just about 30 times earnings. So valuations are not out of line. We look forward to the next few weeks. We think the portfolios are pretty well positioned, but I just want to make this one point. In every presentation we've ever done, we highlight the fact when the breadth models get to extreme oversold, it will feel bad, and the clients will not want to do anything, and there'll be 50 reasons why not to put money in equities. But over now 60 years of history I have in this model, there's 26 times we got to below 30%, and every time it turned higher, you were within a couple of months of putting in a low in the market, and it was time to put money to work. So if I have a message for you, it's that we are in one of those times. And of course, it feels like it's been sloppy, and there's lots of people who are concerned. But based on our work, this market has great risk-reward. And there's some very clear themes that benefit from what's going on out there. And I think when we have a conversation at year-end, once again, we'll be looking back saying, boy, that third quarter was a great opportunity to be putting money to work. So I'll leave it with that, and I'll pass it back to Sarah.
So just before we take any questions, I wanted to thank you for dialing in today and let you know the next monthly conference call will be held on Tuesday, October 27th at 4:15 Eastern Standard Time. If you would like any specific information or client-friendly materials, please reach out to our team. Nick Hamilton, Kayla Peacock, or myself are happy to answer any questions you may have. And with that, we'll open the floor to questions to Dave.